Ever wondered how to make your money work harder for you? Let's talk about one method that's been making waves in the investment world: dividend investing. This strategy is all about buying shares in companies that pay out dividends. But what exactly are dividends? They're a portion of a company's earnings that are given back to shareholders. Think of them as your share of the company's profits. Now, here's the exciting part. Dividends can provide a steady stream of income, separate from any potential gains from selling your shares at a higher price. It's like having a second job that doesn't require you to work additional hours. Instead, your investment does the work for you. This is the beauty of dividend investing. It's not just about owning a piece of a company, it's about earning from that company's success, regularly and consistently. Imagine earning money while you sleep. That's the potential power of dividend investing. But what exactly are dividend stocks? Well, let's dive right into it. Dividend stocks are shares in a company that pay out a portion of the company's earnings to shareholders. These payments, known as dividends, are typically distributed on a regular basis, such as quarterly, semi-annually, or annually. So, why do companies choose to pay dividends? There are a couple of reasons. One, it's a way for companies to distribute excess earnings back to the shareholders. Two, it's a sign of financial health. Companies that consistently pay dividends are often well established with stable earnings. And three, dividends attract investors who are looking for regular income in addition to potential capital gains. But how do dividend stocks differ from growth stocks? Well, growth stocks are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. These companies often reinvest all of their earnings back into the business to fuel this rapid growth, and therefore typically do not pay out dividends. Investors in growth stocks are primarily interested in capital gains, or an increase in the stock's price over time. Dividend stocks, on the other hand, may not offer the same potential for explosive growth, but they do provide a steady stream of income. This can be especially attractive in volatile or bear markets, where the stock prices may not be increasing significantly. Additionally, dividends can also offer a sort of safety net. Even if the stock price does not increase or even decreases, shareholders can still receive income from their investment through dividends. This can provide a level of stability and predictability that is often appealing to more conservative investors or those nearing retirement. Dividend stocks, then, are like the tortoise in the race, slow and steady, but with the potential for consistent returns. They offer a balance between income and potential growth, making them an important part of a well-diversified portfolio. Now, how do you choose the right dividend stocks to invest in? It's like picking apples from an orchard. You don't just grab any apple, you look for the ones that are ripe, healthy, and have a good taste. Similarly, choosing dividend stocks involves scrutinizing several key factors. Firstly, consider the company's dividend yield. This is the annual dividend payment divided by the stock's price. It's a way to measure the bang you get for your buck. To put it simply, a higher yield can mean more income. But wait, don't get too excited about a high yield. It could be a sign that the company is in trouble and trying to maintain investor interest. Next, check the payout ratio. This is the percentage of earnings a company pays out as dividends. A low payout ratio could mean the company is retaining more earnings for growth, while a high payout ratio could mean the company has fewer earnings to reinvest. A ratio of around 60% is often seen as a sweet spot. Another factor to consider is dividend growth. Companies that regularly increase their dividends are attractive because it shows they are growing and sharing that growth with investors. Of course, the company's financial health and business model are crucial. You want to invest in a stable company with a sustainable business model. Look at the company's debt levels, revenue, earnings, and profit margins. And finally, consider the company's history of dividend payments. A company that has consistently paid dividends over a long period is a good sign of a sound investment. To make all these assessments, you'll need to do your homework. Read financial news, study company reports, and use online tools and calculators to help with your analysis. Remember, not all dividend stocks are created equal. It takes strategic selection to maximize your returns. Choosing dividend stocks is not just about picking the ones with the highest yield or the biggest name. It's about finding the right balance of yield, growth, stability, and sustainability. It's about picking the ripest apples from the orchard. So, you've decided to invest in dividend stocks. What's the process? It's not as daunting as you might think. Let's break it down into manageable steps. First and foremost, you will need to open a brokerage account. This is essentially your gateway to the stock market. Most brokerages offer online platforms, making it convenient to buy and sell stocks from the comfort of your home. When choosing a broker, consider factors such as fees, customer service, and the platform's user interface. Once your brokerage account is set up, the next step is to fund it. This can usually be done via a bank transfer. Remember to only invest money that you can afford to lose. Investing should never leave you unable to pay your bills or meet your financial obligations. Now comes the fun part, selecting your stocks. You've already learned how to choose dividend stocks in our previous scene. So, use that knowledge to pick out stocks that align with your investing goals. Whether you're looking for steady income or long-term growth, there's likely a dividend stock out there that fits the bill. Once you've selected your stocks, it's time to place your order. This can be done through your brokerage's trading platform. You'll need to specify the stock you want to buy, the number of shares, and the type of order. If you're unsure about any of these steps, don't hesitate to reach out to your broker for assistance. Finally, once your order is filled, all that's left is to wait for your dividends. These are typically paid out quarterly, although some companies may pay monthly or annually. The dividends can be deposited directly into your brokerage account, ready for you to reinvest or withdraw as you see fit. And there you have it. You're now a dividend investor. This process may seem complex initially, but like any new skill, it becomes easier with practice. Keep learning, stay disciplined, and enjoy the journey of dividend investing. Like any investment, dividend stocks come with risks. What should you watch out for? First off, one of the main risks is dividend cuts. Companies aren't obligated to pay dividends and may reduce or even eliminate them in tough financial times. This could potentially disrupt your income stream. It's a reminder that dividend investing isn't just about picking stocks with high yields. It's also about choosing companies with strong financial health and a consistent track record of paying dividends. Market volatility is another risk. Stock prices fluctuate based on a multitude of factors, from economic indicators to company-specific news. This volatility can lead to capital losses, especially if you need to sell your shares in a down market. Remember, investing in dividend stocks is not just about the income. It's also about the potential for capital appreciation. So, how do you mitigate these risks? Diversification is key. Don't put all your eggs in one basket. Spread your investments across different sectors and companies. This can help shield you from sector-specific downturns and company-specific risks. Another strategy is to reinvest your dividends. This allows you to purchase more shares, thus potentially increasing your future dividends and giving you a buffer against price fluctuations. Finally, always keep an eye on the market and regularly review your investment portfolio. This will enable you to make timely adjustments as necessary. With careful consideration and strategic planning, you can navigate the risks of dividend investing. Want to supercharge your dividend investing strategy? Consider dividend reinvestment. Now, you might be wondering, what is dividend reinvestment? Simply put, dividend reinvestment is a strategy where you take the dividends you earn from a stock and immediately reinvest them back into buying more of that same stock. Why do this, you may ask? Well, reinvesting your dividends can significantly accelerate the growth of your investment portfolio. It's like a snowball effect. The more shares you own, the more dividends you receive. And the more dividends you receive, the more shares you can buy. Over time, this can result in a substantial increase in the value of your portfolio. Now let's talk about dividend reinvestment plans, or DRIPs for short. These are programs offered by many companies that allow investors to automatically reinvest their dividends into additional shares. The beauty of DRIPs is that they often come with no or low transaction fees, making them a cost-effective way to grow your investment. But remember, like all investment strategies, dividend reinvestment comes with its own set of risks. Always do your homework and consider your financial goals and risk tolerance before diving in. By reinvesting your dividends, you harness the power of compounding, potentially turbocharging your investment returns. It's a strategy that can turn small drops of water into a mighty ocean over time.